Hi, my name is Michael Corselli. I'm the founder and chairman of Flya. Today, I have my friend Mike Egan here from Gyroscope Capital Management. Gyroscope Capital Management is here to talk about hedging concentrated equity positions. So with that said, I would like Mike to give us a background of himself and why he started his firm.
Michael, thanks for having me. It's a pleasure to be here. We started Gyroscope Capital Management in 2006, started managing money for clients in 2007. Today, we're going to talk about the use of options to hedge concentrated stock, meaning the client, whether it's an individual or an entity, owns too much of one stock relative to their investment objectives. How do we ensure, protect, or more properly, how do we hedge that position such that the investor, the owner of the asset, has a defined downside and may or may not give up some of the upside, which we'll get to in a minute, in return for some income, some premium associated with that sale of that upside. Gyroscope has 4 team members. We have 2 traders and portfolio managers based in Naples, Florida. I'm based in Naples, Florida, about 100 miles from where we are today in Miami. And we have a teammate named Sarah Wolf, who's worked with the team since the beginning, based in Annapolis, Maryland. We founded the firm to help individuals and related entities, family-related entities, use options that I learned about in my institutional background in New York to do 2 things. The first, and we're going to talk about that just now, is to hedge underlying positions. The second is for equity income. To be really clear, we don't speculate with options. If the client brings us a position that is in excess of what their investment objectives suggest, we're going to hedge that particular position.
So we don't care too much about pedigree here, but give us a little bit of background on your, where you worked, what experience you have.
I sold fixed income swaps on the fixed income derivatives desk at Lehman in New York from 1990 to 1992. And as that's rolling off my tongue, Michael, I'm remembering that seems like a long time ago. That seems like several lifetimes ago. Lehman was a terrific firm. I left in
Absolutely.
1992 to go back to graduate school. Sarah Wolf has been with the team since 1995. And as I mentioned, is based in Annapolis, Maryland, graduate of Washington College. On our portfolio management team based in Naples, we have Rob Carr, graduate of the University of Florida, chemical engineering, and Florida Gulf Coast University MBA. And Anthony Cirillo is our CFA charter holder. He is a graduate of Florida Gulf Coast University based in Naples also.
Very impressive pedigree of the team. So Sarah, who is an important part of this part of your company, you said has been with you since 1995?
1995.
But the firm started in 06. How is that possible?
In 1995, Sarah and I worked together at Legg Mason Woodwalker, based in Baltimore, Maryland, thus her living in Annapolis. Also a terrific firm. We offered substantially similar strategies to what we're going to discuss today at Legg Mason to advisors throughout the United States. And we found that to offer those strategies to clients in an investment advisory format was more attractive to the ultimate client. And thus, one of the major reasons for founding Gyroscope as a registered investment advisor, as opposed to offering these strategies as a broker-dealer.
Got you. It's the world we live in today is relationships don't last very long in social media world. It's amazing how you and Sarah have been able to work together for so long.
A lot of people seem startled when I tell them that, especially when they meet Sarah. She's a fantastic person. She's also very patient and just a terrific colleague. We're very complimentary. Sarah and I face advisors and clients and spend most of our time articulating and translating how do these strategies work to successful individuals who don't think about put options and call options on a regular basis. And Rob and Anthony on the trading and portfolio management side are really spectacular at execution and trade monitoring. So we have a great team of 4.
Got you. Got you. So if I hypothetically were an advisor, how could I spot or identify a concentrated equity position in my portfolio?
It's a great question. We will often be presenting to advisors in a group setting. Remember the old days pre-COVID when we all used to go see each other in person? And we'll ask, does anyone in the room have a client with concentrated stock? And there will be no hands up. And then we'll say something like, hey, in this town, there are these 4 major public companies. Does anyone have a client who works there? And then,
Right.
we get 7 hands and say, well, those are the people with the concentrated stock. So it doesn't intuitively occur to advisors. And I had to investigate why when I was just starting out, because clearly you need to be able to find someone you can help. And what we've learned is that a lot of clients will tell their advisor, hey, I'm going to please ignore my employer's stock, or ignore that stock I inherited, or ignore that stock I bought 20 years ago that has a huge gain and no basis in it, because I'm comfortable with that exposure. And what we try to coach advisors to say is, wow, that's a lot of exposure, a lot of risk to your personal financial plan, to your estate plan, to your family's well-being. We really need to include the analysis of that concentrated stock or that concentrated exposure, if they're still an employee, in your financial plan, in your estate plan. And at least let's just acknowledge it. Maybe as we move along in years, we can start showing you, the client, different ways to address that. So it's often a longer term process. It's not a, hey, I showed you an idea today and the client implements it tomorrow. Often it's a, hey, I told you that this thing actually exists, and 8 years from now, we might implement it the first time.
Okay, so we're talking about from an advisor's perspective, but let's talk about from a end, like, shareholder perspective. The client that owns the stock. How do you, if you're here today and you think that you have a concentrated equity position in your portfolio, how do you identify if it is a concentrated position or not? So how would I think about my wealth and whether or not I'm holding a concentrated equity position?
You know what? That's a terrific question. We don't get that enough. My definition of a concentrated equity position, where whatever it is worth more than 10% of your net worth. If you're worth $1 million and you have a position worth more than 100, to me, that's a concentrated position. Obviously, as you go up higher in terms of net worth, your tolerance for a concentrated position will grow. If someone's worth 100 million and they have 10 million in one stock, that might not be out of line with their investment objectives. However, the majority of clients or investors that we see, if they're worth 10 million, they have 9.5 million in one stock. And look, that's how a lot of people gain their wealth or earn their wealth in the first place. If you were an employee at many, many tech companies over the last 15 or 20 years, or you've worked at a more traditional public company for your career, then if you just keep deferring into your 401k, into a stock purchase plan, you just from time to time keep buying stock. Remember, our parents used to tell us to do this. One day you're going to wake up and you're going to have way too much of that stock from a risk management standpoint. In other words, there's no return on a position that's too big that can justify the risk you're taking as an investor in holding too much according to your investment objectives. If I can give you an example, Sarah and I over the years have been able to help dozens, if not hundreds, of UPS employees, the big brown truck. And a number of them actually drove the big brown trucks. They had worked there for years and years and years. And of course, the stock price had risen along with the US equity market. Great company, UPS, by the way.
Absolutely.
And we were able to help what I would consider to be normal people, normal investors, managers, and actual truck drivers who earned a very concentrated position, but by the same token, they really needed to reduce the exposure, not necessarily sell the stock, but reduce the exposure in order to match a reasonable financial plan offered by their advisor.
So let's help the advisors and the shareholders of these concentrated equity positions identify some situations and scenarios. But instead of talking about numbers, which we do a lot in finance, let's talk about feelings. Like, I like this company. I've done well with this company. Why would I want to sell the stock? Why would I want to put my money in other places? Like, help me to identify some of those situations and either how advisors can handle those situations, or how the person who holds the concentrated position that has appreciated and taken such good care of their wealth, how they should think about it. How should they handle it if you're an advisor? And then how should the client think about this situation?
Sarah and I have a little inside joke that we and most good financial advisors are really part therapist, that your stated job is to provide financial advice and implement it for clients, for investors. But often a lot of what you do from day to day is to help clients and investors get over emotional obstacles that really can derail their financial plan. You made a comment that I was smiling as I heard you say it. I'm thinking back to the late 90s and early 2000s, when I used to travel a lot to Northern California to visit clients of Cisco Systems, the router company, not the food company. And what a great company, and still is a great company. But we may remember in those days that stock went up 100% a year for 5 years in a row. And I don't remember the exact years off the top of my head, but I remember being there during that time. And routinely, employees would say to me, why would I ever hedge this? It goes up 100% a year. And we all know that that's really challenging emotionally to take some risk off the table, because you know you're taking some upside off the table. So I'll answer your question in two different ways. As an investor, make sure that you're thinking about your advisor's financial plan. If you don't have a financial plan, I'd encourage you to consider one as an investor. But make sure you're giving your advisor some thought when he or she says, boy, this stock is great that you work for, you inherited, you selected yourself. Maybe we should take some risk off the table, perhaps in a sale, perhaps in a hedging mechanism, but give your advisor the benefit of the doubt, because you're in that emotional state of euphoria when your stock's going straight up.
Yeah, you fall in love.
You fall in love, right?
Fall in love with the position.
We're humans, right? We all do this.
You don't want to think logically about it.
No, it's working.
I thought when you were going to give an example, I thought you were going to say you were traveling to Texas and, late 90s, early 2000s, and there was this company, Enron, right?
We have a number of companies that unfortunately
that made people so much money.
it did until it didn't.
Until
it didn't.
It was over.
Yeah. And certainly you could talk about MCI, you could talk about any of the companies that went straight up and came straight down, but I think it's easier to think about the millions of employees in companies that went straight up for a period of time, and then for no reason that is specific to the employee or the investor, came straight down or just stagnated. Those are, I would think, the majority. So give your advisor the benefit of the doubt.
Let's talk about what this really is. Let's talk about risk tolerance, right? Are they aware, really, investors or advisors really good at analyzing their investors' risk tolerance?
Boy, that's a difficult question. I think we're all trained as financial advisors to identify a client's risks or the risks of a portfolio And do they match with the client's stated objectives?
By age, we're good at it.
But I would say we're trained as advisors to do it. I think advisors are much better than clients. And most of that is because the advisor doesn't own that stock. It's the client that owns it. But ultimately, if you own more than 10% of your net worth in one stock, this is my personal opinion, you really want to take the time to analyze, can I afford as a client, or can I afford as an investor to allow that client not to address that risk?
So advisors are better at identifying an investor's risk tolerance than the investor themselves. That's what you're saying.
100% agree. 100% agree.
So the investor has a hard time knowing what their own risk tolerance is.
I believe so. Or, excuse me, not the risk tolerance. Maybe I misanswered your question. They can fill out a form, but then they will act completely differently. Again, as we're talking to advisors, we say, look, you're going to bring this up to your client, and they're going to smile and nod their head, say, you know what, we really do own too much of this one stock as a family. And then as an advisor, you'll say, well, then let's do something about it. And they'll say, you know, let's talk about that in the next meeting. And then the next meeting, and then the next meeting, and it's never addressed. So one way I think we can help specifically is we can be that external pressure gently, or that external influence as an advisor to say to that client, hey, we're going to bring Mike or Sarah on a Zoom call, or we're going to solicit their input here. Would you listen to them for 5 or 10 or 15 minutes about their experience with clients like you, investors like you that had a lot of money and then one day didn't because XYZ happened. It's not going to happen to your company, but here's a way we can incorporate a 10-year plan or a 5-year plan. And we don't have to necessarily sell anything in a hedge. You're really just hedging your existing exposure. I'm buying a floor or a customized put option, and that's the hedge. So I still own the underlying stock.
You want to get into strategy now.
Well, we can switch when you're like,
I'm still not done with
all right, let's go back to your
identifying
question.
and getting over the fact that like I'm attached to a specific position. I'm in love with a specific position. I firmly believe most investors don't understand their risk tolerance. They don't understand the risk in these very complex businesses, right? What did GE do 15 years ago? Was it an industrial company?
Or was it a finance company?
What was it? Did GE even know what it did? Right?
And if you're an employee, did you really know what was happening at the top?
You were doing,
good questions.
You were doing great, right? You were doing excellent in General Electric stock until it's at $6 a share, right? In 2009, February of 2009, and going to zero. Like, so doesn't mean GE is a bad company.
Not at all. Great company, great team, great employees.
I mean, is that a good example?
It's a terrific example. You know, we could go through a list of example after example, but to your earlier point, a lot of investors, a lot of employees or retirees would say, oh, but that wasn't my company. My company did X, Y, and Z. Let's pick on a hyper success story if we can. Let me flip the question a little bit. One of my best friends is a fairly senior person at Apple. Does anyone think Apple is a bad stock to have owned over the last, you pick it, number of years?
Say 20 years.
Let's say 20 years. Terrific. Congratulations.
Yeah. I mean,
I've got 4 Apple products. You know, if we could reach our arms out far enough in this room, Michael, you and I could touch 20 Apple products. So we're not talking about the products. We're not talking about the company.
I'm focusing only on the bad examples. I'm not focusing on.
But even still, it's the same question to say to my friend, who his name actually also happens to be Michael, shouldn't you consider hedging or taking some of the risk off the table of that fantastic company because you're so far past your financial plan? Why would you continue to ratchet up your risk by owning an enormous amount of Apple stock? And it would be the same conversation.
So have you had that conversation with him?
I have.
And can I ask if it's okay, did he implement some hedging?
He didn't.
He didn't.
Now it's worked out so far. So if he were sitting here, he'd say,
So what's your
George.
argument on that side?
As an advisor, continue to do your job, which is to continue to identify you have too much risk in this stock. And where Sarah and I can help with that is to show you several ideas. This is via email, right? There'll be ideas that we will email you, and make sure the client's paying, the investor's paying a little bit of attention to that.
So let's talk about Mike. Tell him what you want to tell him.
Mike, you really need to hedge some of that Apple stock. We've had this conversation several times. We need to keep having it, buddy, because you have too much. Congratulations, by the way.
Isn't that tough to do?
Boy, this is a elementary school friend, so I've known Mike for over 40 years. It's not hard for me to have that conversation, but as an advisor, where you make your living with that client, you probably have other assets that you're managing for them, whether you're charging a fee or a commission, and it's your job to keep inching them along the path. I think that's challenging. And again, that's where Sarah and I could be the bad guys. Say, look, you just need 5 minutes once a year for them to talk to you about why you're taking too much risk in all of our opinion. And here's what you can do to mitigate some of that risk. And could we try a little bit of it? So as the advisor, often we'll hear, you know what, I haven't talked about equity options since my Series 7, 20 years ago. And our answer always is, we think about options all day, every day. Let us be your partner, because ultimately that's what we're really good at. And you can only, as an advisor, be good at so many things. We'll teach you along the way. We'll take the hard questions. We'll be the emotional nudge, continuously saying to the investor, you really need to consider this.
So let's talk about what a solution looks like. And you're not a wet blanket, right? You still want people to have upside in their equity positions.
We do.
It's not like you're saying, hey, you're not going to be able to get any of the upside ever again. Ha ha ha. Right?
Correct.
So what is the situation? Give me a live example of a security, and, you know, like how you would structure an outcome for the client, what it would cost. Like walk me through an example of a solution.
Okay, well, let's talk about Apple, because I happen to have that in my head. But
You brought it up.
I brought it up,
We're
exactly.
not going to mention any names.
No more
Mike.
names that Mike, or sounds like our names, and this truly is an individual. He's a great guy. Let's assume Apple's trading at $100 a share, to make the math easy on all of us, especially me. And that the client, the family, owns well in excess of what they should. Doesn't really matter how many shares. It's just, it's a need right now.
It's a concentrated equity.
It's a concentrated equity position as defined by a percentage of what they own. The first step is to say to the client, really the advisor can answer this question, why don't they just sell a component of it? Why don't they sell a portion of it? Sell 25% a year for 4 years. And the answer almost always is,
they have other issues.
Other issues. You have to pay taxes if you have a
Correct.
basis. You don't get the dividend anymore. You might have restrictions on the sale. There could be all kinds of good, logical, non-emotional reasons for that. Okay. So then we sort of walk down a path of, well, if I were to invest in a put option on that stock, remember, a put is the right, but not the obligation to sell something to the seller of the put option. So you have the right to put it to them, to sell it to them by a certain expiration point at a certain price called the strike price. Well, why wouldn't I just buy a put on Apple? Well, the reason is it's really expensive. The more volatile the stock, the more likely a put strike, any given strike, is to be hit, the more it costs. It's just math. It's the Black-Scholes formula, which, don't worry, we're not going to go into today. So what's the next step there? Well, the more volatile the stock, the more I can earn or receive by selling a call option or a ceiling or a cap. Now there's the rub, right? If I sell a call option, I'm capped out at that point. Am I willing to exchange the risk of hitting a ceiling for the certainty of having a floor? There's the emotional question. But my stock's going to keep going up. Maybe it will. But isn't it some step along the way, it more critical that you have taken away some of your risk? So as an example, if Apple were hypothetically trading at 100 and we bought a floor or a put at 80 and sold a call or a ceiling, I need a third hand here, at 120 for a year. There you go. Okay, thanks for helping out there. So here's my range, here's my collar. I've basically taken, in my example, 4/5 of the risk out of it. Now, whenever that matures, whether it's 6 months, 12 months, 24 months, there's a whole range of these. These are customized to the investor. We need to have that conversation again. But we're now on the path of, in my opinion, helping the client identify, okay, I hedge 10% of what I own. I still have all the upside on the other 90%. Maybe a year from now, we can help them get comfortable with hedging 20% and 30% and 50%. As most clients age, their risk tolerance drops. Happens to all of us, again, humanity. So the older the investor, the easier this is on average for advisors. And once an advisor gets comfortable gently challenging the first client, it's really easy. It's easier, I should say, not really easy, easier to challenge the second client, the third client, because you get more accustomed to the objections. Part of our job is to help coach you through that. And again, to be there when you want us to be there, and to be the bad guy if the client says, oh, I never want to talk about that again.
Does risk tolerance change, or do people become like more aware of their risk tolerance?
Oh boy, that's getting into some serious psychology.
Philosophy stuff.
Yeah, boy.
And this at the end of the day, I think is the reason why this is such a difficult decision to make, is because we human beings don't understand our own risk tolerance.
I would agree with you. I think it's very difficult for most humans, myself included, to learn. But I do know that I feel much worse when something goes wrong versus feel good when something goes right. So fear versus greed, for me personally, fear is a lot stronger. Do we get better at risk tolerance? No, except when you've hit the wall and it hasn't worked. I think you naturally, as an investor, become more conservative. Often that's at the wrong time, right? If my stock is at 100, it goes to 50.
Oh, no,
I don't want to sell at 50.
That's when you have dislocation.
Correct.
Right?
Correct.
And irrationally made decisions.
Correct.
Bad timing, all the horror stories happy at when you hit the wall.
Correct.
Which is, I didn't want to ask you your personal risk tolerance, but I'm glad that you shared it. Right? Because at the end of the day, this is about human beings and how they think about their wealth, which is a very intimate thing, right?
Agreed. And it's very specific to each family member. You find that two spouses have very different risk tolerances. And in conversations where both spouses are present, often I've seen the most skilled advisors bring up the topic and then take a step back and listen and wait to see how that conversation goes, because that's effectively the advisor giving the spouse's permission to bring this out in the open and get those sensitivities some air, give them some air.
I mean, I think advisors could be committing malpractice if they don't discuss this with their clients. And it's very hard to bring up, as you're aware, if you're earning a living from this. Person has a concentrated position, they've done really well, they don't want to sell it, it's a liability for them, you see it clearly, right? They don't see it clearly, they're emotionally attached to it. And all you're looking to do is put together some risk management, leave them in the game, but take out the really bad scenarios.
Agreed. Take out the worst case scenario.
So you get 20 up, 20 down,
In my example, correct?
right? That could be adjusted,
It could be, yeah.
right? And how do I get this? How do I get access to your brain, to your intellectual property, your years of experience? How do I access it if I'm an advisor or if somebody who owns a ton of Apple?
Yeah, great question. Sarah and I, again, are a team. So, and I'm told most people like her better anyway. So by visiting our website, I'll leave with our phone number at the end. Reach out to us directly. We're available on most TAMPs, including InvestNet, Mount Yale, et cetera. We are available at most custodians, Fidelity, Schwab, Pershing, RBC, et cetera. If we're not on your custodian, if we're not available at your firm, whether you're a registered rep with a broker dealer or an investment advisor representative of an RIA, we'd like to help you. We'll figure out a way to do that. But our first job, I think, is to make sure each advisor has at least a reasonable understanding of how the strategies work. And I don't know that we have time for that because this is a live version. We can't just keep going on forever.
Right.
So take us up on that offer. Give us a ring, reach out to us via email, and let's go through a quick conversation, maybe even just 5 minutes of how does this work? And does it apply to your particular client, your particular investor, your prospect?
By the way, I don't think you ever answered what it costs.
Oh, terrific question. In my simple example, $100 stock, $80 put, thank you, $120 call, we will almost always structure that call option such that the premium received exactly offsets the put option. Combination of that put and call, the term for that is a collar. And if the income from the sale of the call exactly offsets the cost of the put, the term for that is a costless or zero premium collar. Cashless. It's not costless. It's not free because you're giving up upside above that call strike, right? You're capped out there for that period of time.
But you don't have to pay any money out of pocket.
You do not. Now, Gyroscope, my firm, is going to charge an investment advisory fee to the client ultimately. The advisor should charge a fee also. So the cost to the client will be the fully disclosed investment advisory fee.
Got you. How much time do we have? All right, so we're almost out of time. We have 3 minutes left.
Okay.
Is there anything that you would like to add about this strategy? And if there's not, I'd like to just quickly ask you a couple of questions about other things that your company does.
You know what? I could go on forever. Let's let you hit your questions. And if we run out of time, then we can do this again another day.
Sure. So what are some of the ways that you help investors find income and capital appreciation?
Thank you for that. Our company, really, Gyroscope Capital Management, does two things. Again, informed by the use of equity options and how impactful those strategies are to institutions. They can also be impactful to individuals and families. We just talked about hedging, where a client owns too much of one stock. The other side of using options is to sell that call option. Remember my $100 example, if I just sold that call option, I would keep that premium and put it in my pocket. Our firm manages several equity income portfolios, which are designed to earn additional income, spending money, by the sale of those covered call premiums on a regular basis. Now, this is almost a flip of what we're doing with hedging, because in the hedging side, the client brings us the stock. We don't get to choose that. On the equity income side, the client is bringing us cash to invest. Rob and Anthony, our portfolio managers, are selecting the securities that underlie each of the portfolios through a very robust process. 3 different portfolios.
Three strategies.
Thank you. 3 slightly
dividend income,
dividend income, which is US large cap value. growth and income, which is US large cap growth, and our S&P 500 optimal weight, which is US large cap core. So concentrated portfolios or strategies upon which we then sell covered calls every 30 to 90 days. And the income from those portfolios is anywhere from 4% on our growth portfolio. This is last 12 months as at the end of 2021, all the way up to 6.2% last 12 months as of the end of last year on our dividend income portfolio. So substantial income.
So investors get paid while they wait for capital appreciation.
That's exactly right.
And
great way to think about it.
It's through dividends.
Correct.
And it's through premiums from writing covered calls.
Correct. Correct. And to your point, then the securities that our portfolio managers identify and purchase, we're buying stocks we think are going to appreciate. And in fact, over the long haul, these two of these portfolios started on October 1 of 2007. And the third, I believe, was 2013, but I don't have that one right on the top of my head. So this is not something we just started last week. These are substantial time periods. All of the results are on our website, and we would encourage advisors to reach out to us and for a more fuller explanation than 3 minutes.
Absolutely. So tell everybody today how they can get a hold of you.
Gyroscopecapitalmanagement.com. I'm at 239-219-0555. And I believe they can find these materials or some of our materials on the FLIA website. So if you're a FLIA aficionado, which I am, please visit the FLIA website.
So we will be following up with an email for all the attendees today with links to the materials that we have from Gyroscope Capital Management. We'll also put a way for you to get in touch with Mike or Sarah directly in the follow-up email. And I hope that you enjoyed our fireside chat today. I really enjoyed it. I learned a lot from Mike Egan today. I want to thank you so much for coming in, and good luck and best wishes to everything in 2022.
Thanks, Michael. It was a pleasure.
All right. Thank you.